In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and review then rate the company. Today we are going to look at Novo Nordisk, ticker, NVO. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics achieve or exceed a specific target. Companies can earn 1 point for fully meeting the target or 0.5 points for coming within 2% below the target. The first pillar is earnings per share growth. This is where we take the net income and divide it by the shares outstanding. For Novo Nordisk, earnings per share growth over the past 12 months is 9%, which is 1% below the 10% target, scoring 0.5 points. Next, let's look at free cash flow growth, which measures the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. Novo Nordisk's free cash flow growth is 13%, exceeding the target, scoring 1 point. Next, we come to revenue growth, which tells us how good the company is at generating income before deducting expenses. Their revenue growth is 12%, exceeding the 10% target, scoring 1 point. Now let's turn to book value growth, calculated by subtracting total liabilities from total assets to indicate equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, Novo Nordisk's book value growth is 8%, which is 2% below the target, scoring 0.5 points. We then assess the management of the business by looking at return on invested capital and return on equity. These measures allow us to evaluate a company's efficiency at allocating capital. For Novo Nordisk, return on invested capital is 53%, and return on equity is 79%, both far exceeding the 10% target, scoring 1 point for each. Now we move on to debt. Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow within 3 years. Novo Nordisk's debt ratio is 0.36, which is well below 3, scoring 1 point. With the information we have gathered, it tells us that aspects of the key pillars are solid, but let's explore the company further. Now let's look at the remaining key pillars which help define an excellent business. Let's start with the gross margin, which indicates how much money a company retains after incurring the direct costs of producing its goods or services. This is currently at 85%, exceeding the 40% target, scoring 1 point. Next, we come to the operating profit margin, which tells us how much profit a company makes on $1 of sales after production costs but before interest or tax. Peter Lynch prefers companies with strong operating margins when assessing their financial health and competitive advantage. Novo Nordisk's operating profit margin is 46%, far exceeding the target, scoring 1 point. Free cash flow yield provides a more realistic view of a business's financial health. Terry Smith prefers companies with a free cash flow yield of 5% or higher. Novo Nordisk's free cash flow yield is 6.23%, exceeding the target, scoring 1 point. Next, we assess the 10-year book value growth as potential shareholders. For Novo Nordisk, this is 13%, exceeding the target, scoring 1 point. Lastly, Bill Miller believes earnings growth is the biggest indicator of a company's stock price. The 5-year net income growth, which evaluates the company's profitability over time, is 19%, significantly above the target, scoring 1 point. In the description, I've included a link to the investors page and the annual report if you want to check it out for yourself. Novo Nordisk has demonstrated strong fundamentals over the last 5 years. However, the stock price has experienced volatility recently. As of January 18, 2025, the stock is trading at $78.69, reflecting a 5.26% decline from the previous close. Over the past 52 weeks, the stock has declined approximately 22.48%, attributed to challenges such as disappointing clinical trial results for its experimental weight loss drug, CagriSema. Looking at the overview, we can see the current market cap is $352.7 billion. They are currently generating $40.47 billion in revenue for the trailing 12 months and have 4.45 billion shares outstanding. At present, their earnings per share tell us that for each share of stock, the company is generating $3.17. Their price-to-earnings ratio is 24.90, which is lower than the S&P 500 average of 30.63. The overall consensus among analysts is a strong buy, with a price target of about $134. In addition, analysts are forecasting the average growth rate over the next 3 years to 23%. Let's calculate a valuation. I will use Novo Nordisk's current earnings per share of $2.93. Combining historical growth rates and future analyst predictions, I estimate an earnings per share growth of 15%. Assigning a forward price to earnings ratio of 35, projecting 10 years forward, and applying a desired return rate of 15%, this results in a future stock price of about $415. The current intrinsic value is about $102, which gives me a buy price of $77. Since the current price is within 5% of the buy price, this scores a check. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. When reviewing the key pillars, Novo Nordisk scored 11.5 out of 12, earning a check. Over the last 6 months, the stock has experienced a significant decline, reflecting the broader challenges the company has faced, scoring a cross. Analysts are predicting a growth rate of 23%, scoring a check. The current price is near the buy price, signaling a check. According to Morningstar, Novo Nordisk has a wide economic moat, which scores another check. My final overall rating is 4 out of 5 stars. I've placed this stock in category A on my stock watch list, noting it has strong growth potential but recent challenges should be monitored closely. Thank you for joining me in today's analysis. Don't forget to like and subscribe for more insights.